In this video segment, we're going to use a pretty short set of information to show you how to prepare a statement of cash flows when we use both the direct and indirect method for the operating section of the statement of cash flows. It's also going to be a little bit more realistic than some of the examples I've talked about earlier. Instead of having a sheet in front of us that shows us all of the cash transactions and only needing to define whether they're operating, investing, or financing, we're going to prepare the statement without having access to all of that detail. Instead, what we're going to be doing is we're going to be relying on three readily available sources of information to companies who are actually preparing their statement of cash flows. We'll have the income statement, we'll have balance sheets at the beginning and end of the period, and then there's going to be a few things that we will actually need some additional detail on, and in real life people know that there's certain accounts that they're going to have to go back and look at some transactions for or ask questions about in order to complete the statement of cash flows. But honestly, most of the statement of cash flows can be completed if you have an income statement and comparative balance sheets. Our little company will be called Joe's Place. We'll have balance sheets at the end of year 1 and year 2. We'll be preparing a statement of cash flows for year 2. We'll also have the income statement, of course, for year 2. This is the income statement for year 2. Net income, computed under the accrual method of accounting, turns out to be a loss of $19,000, and you can see our various categories here. As I said in an earlier video, having an income statement really doesn't tell you very much about what cash flows would be. Joe's Place has $727,000 of revenues, but what we want to know for statement of cash flow purposes is how much cash did they actually collect from customers during year 2. Cost of goods sold is reported here. It's just the cost of those goods that they sold to generate this amount of revenue. For a cash flow statement, what we really want to know is, but how much did you actually pay for inventory during year 2? And that's very different than cost of goods sold. Depreciation doesn't use cash at all. Gain on sale of land doesn't tell us anything about how much cash they got when they sold the land. And of course, on a statement of cash flows, we want to know how much salaries did you actually pay out in cash, not what was your salary expense. So we need to be adjusting all of these things when we go to do our statement of cash flows. Here's one of the pieces of additional information that we would need to look up and ask about to prepare the statement of cash flows. Here we're being told that this gain on sale of land was because we sold land for $40,000 that had cost us $32,000. We would also have in front of us comparative balance sheets, so balance sheets for the current year, which in this case is year 2, and the prior year of year 1. Here we're just seeing the assets for the company. On the next page I'll show you the rest of the balance sheet. One of the things that we see here is that cash started out at $90,000, ended up at $62,000, so there was a $28,000 decrease in cash, and that $28,000 decrease in cash is what our statement will be explaining. Here's the rest of the balance sheet. Got information about liabilities and equity. And here's one more piece of additional information. There was an important non-cash transaction that, as you'll see later, would actually get disclosed on the statement of cash flows. The business gave $50,000 or issued $50,000 of no par stock to settle the $50,000 note payable. So this note went from $50,000 to zero at the end of the year, and common stock went from $450,000 to $500,000 as a result of this transaction. And I'm not showing you the entire statement of shareholders' equity, but here is basically a little mini statement of retained earnings so that we have that information as well. Beginning of the year retained earnings was $46,000. You'd subtract that net loss from the income statement we looked at, and here we have some information about dividends that were declared and paid in year 2. That was $20,000, and that's what got us to the ending balance in retained earnings of $7,000. What we'll be using as a reference, sort of a cheat sheet in preparing our statement of cash flows, is this guide that you have available to you as part of a handout in the unit. So you might want to have that in front of you. When we are using the direct method to compute cash flows from operations, we'll be using just these 2 columns of the guide, and when we switch to the indirect method, we'll just use this column of the guide. And this is just an easy way to help you remember whether we should be adding or subtracting changes in various types of accounts. You'll see how I use this guide in a little bit when we do the example together, but basically you need to be able to recognize on the balance sheet which asset and liability accounts hold the difference between accrual basis income and cash flows. And those asset and liability accounts I'm calling here operating asset accounts or operating liability accounts. An example of an operating asset account, again, this is the definition just for purposes of the statement of cash flows, would be accounts receivable. Accounts receivable is one of the accounts that holds the difference between revenue and collections from customers. So accounts receivable holds the part of that difference that's related to the fact that some of a company's sales might be on credit. If accounts receivable increases during a year, that means that a company had more sales on account than it had collections on account. If a company's accounts receivable decreases during the year, that means that the company collected more from its customers during the year than it had sales on account. So that's the manner in which we'll be using these descriptions. Our first demonstration here is going to be preparation of the statement of cash flows using the direct method for our operating cash flow schedule. Because we'll be using the direct method, remember that we would also have to include that supplemental schedule in the footnote that uses the indirect method. When we use the direct method, we basically look at every account on the income statement and think about which of these accounts has a corresponding impact on operating cash flows. We know that revenues would be represented by collections, cash collections from customers on a statement of cash flows. As I said earlier, cost of goods sold, the cash flow side of that would be, well, how much did a company actually make as payments for their inventory? And salary expense here, the cash flow counterpart of that would be, what did a company pay for salaries? The proceeds from the sale of this land don't go in the operating section of the statement of cash flows. Those would be an investing cash flow, so we'll ignore those for the operating cash section. And as we said earlier, depreciation does not use cash. That's simply allocation of a cost, and the cash flow result would have been noted earlier as an investing transaction. So for the direct method, we're going to be focusing on these 3 accounts and coming up with the cash flow equivalent of those. I'm going to refer back here to this guide that you have in your handout. When we are converting from a revenue account to a related cash inflow, you'll use this column of the guide. When we convert from cost of goods sold and wage expense to those related cash flows, we'll use the expense column for those conversions. All right, well, let's start out by converting our accrual sales revenue of $727,000 to cash collections on account. We start by comparing the end of the year balance in accounts receivable to the beginning of the year balance in accounts receivable, because accounts receivable would be one of the accounts that would hold that timing difference. Accounts receivable went from 23,000 or from 40,000, excuse me, at the beginning of the year to 23,000 at the end of the year. So this operating asset type account had a $17,000 decrease. What the little guide is trying to tell you is to use this guide. You start out with your revenue under the accrual method, that's $727,000 from the income statement, and if there was an increase in an operating asset, you would subtract it. If there was a decrease in an operating asset, you would add that to the $727,000. We had a decrease in the accounts receivable account, so the schedule tells us to add that $17,000 to the revenue. Now, we would also have to consider whether there was a liability account that held some of the difference between accrual revenue and cash collections on account. If Joe's Place had an unearned revenue account, we would look at the change in that unearned revenue account and we would either add it or subtract it, depending on whether the account increased or decreased during the year. In this case, we didn't have an unearned revenue account, so the accounts receivable adjustment is the only one we need to make. The cash that Joe's Place collected from customers during the year must have been $744,727 plus 17. Now we'll follow those same steps to convert from $48,000 of salary expense on the income statement to cash paid to employees, which will turn out to be $53,000. Scanning the balance sheet, the only account we see that would account for the difference between accrual expense of $48,000 and cash paid to employees would be the salaries payable account. Salaries payable started out at $14,000 and decreased to $9,000 during year 2. So this is an operating liability account and it decreased during the year. Our schedule tells us that if we have a decrease, and again we're using the pluses and minuses from the expense column now, because our liability account decreased during the year, the schedule tells us we should add that. So $48,000 plus $5,000 is $53,000 of cash paid for wages during year 2. The next chart's a little bit more complicated. We're converting from cost of goods sold of $700,000 to cash paid for inventory. And there's actually a couple of accounts that are involved here. The difference between cost of goods sold and cash paid for inventory relates to a couple of things. Number one, when a company buys its inventory, it might buy it on credit, so it might purchase inventory and pay for it in 2 different accounting periods. Furthermore, cost of goods sold isn't the cost of inventory that was purchased during a period, it's the cost of inventory that was sold during a period. So here we have to look at changes in both the inventory account and accounts payable. Inventory increased by $50,000. It's an asset account, so since it increased, the chart tells us to add that. Accounts payable increased by $11,000. It's an increase in a liability. The chart tells us to subtract that. So $700,000 plus 50 minus 11, this gives us cash payments for inventory of $739,000. What we just did is compute all of the operating cash flows of the company. We had an inflow of cash collections from customers and 2 types of outflows. Operating cash flows in total for Joe's Place, cash outflows of $48,000 from operating activities. Now, the other approach that we could have used instead of the direct method would have been the indirect method. And the indirect method as you recall, is the one that's commonly used by almost all corporations. Basically, you start with net income and then you add and subtract various items that reconcile net income to operating cash flows. Similar to what we just did into the direct method, we're basically analyzing changes in all of those operating type asset and liability accounts on the balance sheet and adjusting for a couple of other items as well. For the indirect method, we're not going to use these two columns at all. We're just using the column labeled indirect here. Notice that the direction of the signs is the same as the revenue column over here. But we have one other item to consider, and that's some adjustments that are necessary for things that don't affect cash at all. So this column, you'll start with net income, adjust for all of these changes, adjust for non-cash items, and what comes out on the other side is operating cash flows. Those non-cash adjustments that were at the bottom of the guide are generally things like depreciation, depletion, and amortization. As you know, depreciation doesn't involve cash. You're just allocating the cost of something purchased in a previous period. Since it reduces net income, but it doesn't have a corresponding impact on cash flows, we add it back to net income to take that effect away. Adding it back to net income doesn't mean it's generating cash flows at all. We're just zeroing out the impact. So we're trying to show what net income would have been if we'd have never taken depreciation expense in the first place. We'll talk later about depletion and amortization. The terms have a very similar meaning to depreciation. The other common adjustment, and the only other one that you'll see in this course, is that we will add back any losses on the income statement or subtract any gains on the income statement. And that's because we're not interested in the gain or the loss. What we're interested in instead is the cash proceeds from any sale that would have generated a gain or loss, and those cash proceeds would not be operating activities, they would be investing activities. So similar to what we did for depreciation, we're removing the effect of gains and losses from the net income item before we start to convert it to cash flows. There are actually dozens and dozens of other adjustments that companies might have to make. They're all beyond our scope at this point. Here's what our indirect method format would look like for Joe's Place. We're starting with the income statement amount. It was a loss for Joe's Place. You can see that down here at the bottom, we've had to add back depreciation expense and subtract the gain on the sale of land, just as we talked about a moment ago. All of these other adjustments are for the many changes in those operating asset and operating liability accounts. And the directionality of these could be traced back to that guide that you have in front of you. Remember to use the indirect column and you'll see how it's telling you to add or subtract depending on whether these were increases or decreases and whether the account was an asset or liability account. Of important note, by the time you do all of this math, what comes out on the other side is that operating cash use of $48,000, and it's exactly the same amount we got when we did the direct method. One thing I think you'll note is that for most people, looking at the indirect method here doesn't really give you a very good sense of how much cash came from customers, how much cash was paid for salaries, or anything like that. So it's not quite as easy for someone to glean that kind of detailed information about operating cash flows. On the other hand, it's a beautiful reconciliation between operating cash flows and the income statement bottom line. Well, now let's go ahead and see if we can complete this statement. An actual statement would, of course, show you the details that we just looked at in the operating section here, either under the direct or the indirect method. We'll start with what we know. We knew the beginning and ending balance in cash. From those two numbers, it's easy to see that cash decreased during year 2 by $28,000. 62 minus 90 is that decrease of $28,000. We've also previously computed our operating activity cash flows to be a decrease of 48 grand. For Joe's place, the only investing activity was the sale of that land. So as you remember from some of our early information, they sold land with a cost of $32,000 for $40,000, generating that $8,000 gain. What shows up in the statement of cash flows is the actual cash effect, or the $40,000 of proceeds that they collected. For financing, cash financing activities, the company paid dividends to the owners. That's an financing use of cash, so we see that here. The negative 48 grand, positive 40 grand, and negative 20 grand all net to $28,000 decrease in cash for the period. So you can see that we've told the reader that cash decreased by $28,000, and we've now provided them some detail on that $28,000 decrease in cash and what created it. The detail for operating activities, of course, as you know, would show up here as well. I'm just shortening the statement. Finally, there's some additional disclosures that are required for a statement of cash flows, and one of the additional disclosures is that a company needs to disclose any substantial non-cash financing or investing activities. So here the company would also disclose the fact that they paid off that $50,000 note by issuing some additional stock.